Alright, let us continue here in this video. This video is going to be about candlestick patterns, a little segue to the last video that we just had. So let's talk about one of the rules we're at in VPA trading. This is going to be for volume price analysis. So the lower wick, and this is the example of the picture. It's all in the Discord. I'm free and exclusive towards the people that are serious about benefiting themselves, right? So let's continue here. So the lower wick example, it's all about psychology when it comes to anticipating the market and reading the market makers' plays strategies. So when the bulls take control of the battle and win the close is the most important part in my opinion. When validated with the trading volume psychology of the bull and bear traps, when the shorts are going to be taking their profits and whatnot. I hope this makes sense to you. I hope this language, you understand this language, right? If you understand this language, this is a really good thing because you've probably been studying the books and you've probably been studying the Discord a little bit and meditating. Like I said, meditate on this information because you got to think about it all the time because it's the whole world, right? It's the whole worlds are based on these laws of cause and effect, supply and demand, so on. What's the last one? Comment in the discussion. What's the last one? It's the law of Wyckoff, the last one, the third one. See if you're a serious student. Okay, next, psychology. This indicates a strong bullish sentiments. If you're a serious student, you're definitely getting into the Discord. I want to invite you in. I want to have the best people that are serious about trading, right? So this includes bullish sentiments, right? This is a bullish candle especially at the end of the bull bear trend. So usually located at the bottom of a bearish trend and causing a reversal play. Boom. Next, the hammer candle. The hammer candle is a sign of strength, a forced buying on the market. This is what when we're talking about the order books, right? So forced buying. This is average volume. This is so this is the volume. The hammer candle, bang, ultra high volume. So forced buying on market. That's because they're closing on market, causing a wick, causing a demand wick. With all the selling have been absorbed, they're just basically taking all of the orders off of the books. So someone wants it, someone's demanding. So many times is the cause of a short squeeze and a temporary reaction leading to more continuation until all selling has been absorbed. This is why the principle of the market making is so important, and we're going to get into that into the next stage analysis, is being the absorbed. This one is really awesome. I really like that idea of the market when we're talking about the phases of accumulation, distribution, trending, and all that stuff. So the next thing I wrote down, this is a summary, guys, a version of the chapter, of the whole chapter. So it's basically the reason that you know it's forced buying is because a wick. The wick is signaling strong bullish close, right? The wick right here, caused by buying on the market or order book manipulation. Here's where you need to use your VPA skills to discern if this is a real or fake move. Volume trend idea confirms demand or supply. Okay, so remember that it can only be a reversal or a continuation if all supply has been absorbed. So this is why it's important to understand the next phase in this series, is that you need to understand if the supply has been absorbed. If it is absorbed and there's no more selling, that the bulls can continue and the market makers can continue to trend the price. And that's why they're probably buying on market. They're not using limits anymore. They're buying on market, causing it wick, causing the supply to be absorbed on the books, on the order books. Hope you guys hope that makes sense. If there's any questions, don't hesitate to ask in the comments. I will reply. Next, the upper wick. The upper wick is right here. Boom. The same thing, but on the downside. So when the bears take over and close this candlestick patterns, Guys, the whole point of this Discord is to master the basics. Of course, everyone kind of knows what this is, but it's the thinking behind the market that will cause these things to fruition. This is the market makers. They're human nature. They're humans, right? And also algorithms, but the humans program algorithms to know what the supply and the demand is. So let's talk more about. So the upper wick is when the bears take over and close with the candlestick pattern validated with traders volume psychology indicates weak market sentiments usually at the top of bullish trend causing a reversal play. So they're selling on market, they're selling on the order book, whoever's willing to take it, and then it causes the price to go down because they're selling on any order. So the shooting stars, the next idea here, the shooting stars signals potential weakness. The pattern gains significance when you use a volume psychology. Volume confirms if participants are truly selling. So if there's a lot of volume, they're actually selling, okay? And then there's also people buying. So it's like balancing the scales. For someone to sell, there's got to be a buyer. For someone to buy, there's got to be a seller, right? So that's kind of where you have to anticipate the price. So furthermore, when according to psychology of this candle, you would know that traders are selling using market orders. Now I can't emphasize that enough. You'll know that because of the candle right here. So they're selling on orders. And so it indicates a warning of potential weakness depending on how much trapped buyers are at the top of the trend. This information will lead you to uncovering how much momentum the play has by knowing how many traders are trapped at the top here. Take a look at this picture. She also covers this one right here. So if you have one candle like that, it's okay. It's like we don't really know, are we at the top here? And then it comes back, pulls back, breaks out, and then you have two right here, double top, multiple confluences, probably bearish divergence, 5 waves, all the good stuff, and then it comes down. You want, again, remember, you want to be a bull in a bull market and a bear in a bear market and know when it starts to change. And that's what's the next idea that we're going to cover. So the long legs doji is basically the same type of deal here with the volume. So low volume, indecision, ultra volume. So when there's a lot of volume, this is where you know that there's going to be a lot of traps or people in the market either interested or trapped. All right. So they actually want it or they're trapped. So it depends again what time frame significance you're looking for. That's why we have 3 time frames, right? If you see this on the 5-minute chart, you want to compare it with a 15-minute, with a 30-minute, with a market psychology. You know what I mean? Of what's good here. So mastering this technique, the volume VPA, is a really good tactic to help you understand what the market. So mastering the basics, guys. You have to master the basics, really understanding the thinking behind the markets. I mean, I can't stress this enough, how much VPA has helped me in my trading by anticipating the market makers and the pressure. So a lot. So let's talk about signals indecisions. Were bullish and bearish market sentiments equally balanced, and it also signals a potential reversal depending on how much volume in the position has the candlestick in the trend. So guys, basically, like, I'm going to start trading heavily in September. So that's in about 1 month. Okay, so right now I'm just basically making tradable setups for VPA, and you can understand that it might take a little bit of thinking to actually make plays out of these things, right? Because it's mostly thinking on the VPA side of things. Elliott waves, there's setups already basically made in here, and then the trading the MM, we're going to cover that as well with trading setups. But yeah, basically this causes a reversal depending on how much volume. And it's an indecision candle. It's called an indecision candle until there's a decision that is made. So a widespread candle, we talked about this, signals strong bullish sentiment in the last video in the direction of the close. So just look at the volume confirmation. If there's a lot of volume and is basically strong bullish sentiments. Let me close the window here. All right. Next is narrow spread candles, weak market sentiments. Although this could be a warning taking place as anomaly pattern. Anomaly equals narrow spread candle with large volume, which basically means a trap. What this means is trap. This is a really good note. Like you should know this one right here. So when you're looking at the market, you see a small candle like that with a large volume, you know that people are selling out, and that it's basically a trap. Especially if it starts reversing, and some people are going basically all this volume is going to have to take a loss, and maybe even more. And then some people are going to enter shorts, and then it's going to be too overbalanced on the short side, and then it's going to cause a reaction to the upside. That's basically how markets work. It's just like ping pong, or a balancing of the scales, like a teeter-totter. And so until there's an actual break. And the breaks are where you can make a lot of big money, but you have to anticipate and you have to know when they're going to come, because they don't come very often. The big breaks like we saw in March in the COVID, yeah, those big breaks, they don't happen very often, but when they come fast, hard, and they don't give you the chance. And that's where the people basically sit on losses and get liquidated, because they don't have, they trade out based off emotions and not off of strategies, which you need to do in order to be a successful trader, as Gann says. The hanging man signals weakness in the market. This is market selling and taking bids off the market, right? They're selling on order book, you can see by the wick. But what happens is that actually, so if at the top of the trend, it could be too risky for market makers to support the price. So you got to really think about the market makers, like how they're thinking about the market. Like they might not want to buy here because it's so high, and they can buy a little bit lower, reaccumulate. So instead, they do a test, what's called a test. And we're going to talk about that later. But see how this is above average volume? This is not good. That means that there's actually selling. There's actually supply coming in the market. And that this is not really a big close, even because here's what happens when it comes to the order book manipulation. The order book manipulation, basically they sell on the market, and then they manipulate the order book so that they can actually push the market up a little bit on low volume. You'll know that a lot of times, especially on altcoins, on lower time frames. If you go down to the 5 minute, that's why we have different degrees in time frames, 3 of them to be specific. And then you go down to a lower time frame, and you see that the volume is low on the upside, on this upside. Right? Let's say that this is a 30-minute candle. You go down to a 5-minute chart, you see that the volume is at weak to the upside. That's classic order book manipulation. So sell out and then de-risk their positions. That's the market maker psychology. And always use volume psychology to see if there's a test pattern that we're going to get into the next video, or in a few videos or series, to see if it's a good. It's important to know what the test pattern is. So if there's a lot of volume at the top, you know that the market makers are selling off and willing bids. So if the volume is high, you know that people are selling to any buyer. So for example, let's take a look at Bitcoin here on the daily chart. I'm actually going to use the 3-day chart. So for example, right here, there at the top of the market, it takes a long time to distribute, right? In a market. Not talking about the 1-minute chart there, but even those, the same thing. So what happened right here, these guys were, after they would sell to any willing buyer on the market, on the order book. So you see this wick, it opens, and then they decide what's on the order book, right? What's on the menu? And then they go, okay, there's this many orders until we take out the $50,500 low. Okay, we don't want to take out the low yet. So how much can we sell? So they go off and sell it. And here's the thing. It's not just them selling. There's stop losses and all that stuff. So what these guys do is they start selling and cause a huge panic, right? Because of the stop losses. And then they recover right here, a couple points right below the low, and then cause the wick to come up. Now the question here is going to be, what's the question that we asked earlier? Is this on low volume or is it on high volume? So if we're using the 3-day chart, I'd have to go down to, let's say, the 3-hour chart, and we figure out if this is high volume or low volume, right? So this one right here was on low volume compared to what was just sold. So that was the sell, and then it came back up basically on low volume. You see this right here? That's a low volume right there. Low volume, and then guess what happened? More selling came in the market, right? So that's what you want to be looking for. You really want to be looking for, and watch. You take a look at the measured move right here, and you say, okay, that's how you measure your Fibonacci or whatnot. So, and it got front run, which is an even more bearish sign, guys. So once you take a look at all these things, you can really get an understanding and the perspective of the market, and you will be making money. Next thing that we want to talk about, because this is technical analysis, right? The science of technical analysis is your money management. The money management and not being afraid to take a trade is by one thing. It's called the rule of the 1% rule. When it comes to money management, Gann has a different rule. He uses the 10% rule. So never lose more than 10% of your equity on one trade. But what Gann uses is the daily, the weekly, the monthly charts, right? What the MM theory, the 1% rule, never lose more than 1% of your whole account. This guy uses the 15-minute chart, which actually gets him a bunch of trades in the same day. Of course, you don't want to use your 10% of your account because that will screw with your psychology. And you'll be afraid of taking the trade and even letting it ride. So instead, you want to be comfortable enough to take the trade, be confident in your setup, and also ride the trade, go with the trend. So 1% is usually the point where people are not afraid to take any trade. Once they see the pattern, they can take it with a 1R loss, 1% of their account. So continuing, we'll talk about risk management later. That is a very extremely important concept. Is like, so Van Tharp is a trading coach. He trains professional hedge fund managers and traders. Like, we're talking about the big billionaires like Paul Tudor Jones and all these guys. He trains them, and he basically develops systems. Psychology is 100% of your trading. You have to master your psychology before you even start trading. And then he says 10% is trading, or your method, and then the rest is like money management and psychology. So a split between those. I think that's his percentages, if that even makes any sense, because 100% of it, I get it, but his point that he's trying to make is psychology is psychology, and then money management is like extremely important as well. So psychology of the test pattern. If there's a lot of volume at the top, you know that the market makers are selling off willing bids on the order book, right? So like we just saw in Bitcoin, public buying at highs. The public. Here's the thing with the public. The public are like, oh, I want to buy a 40K or I want to buy a 50K or whatever it is, right? So what they do is they do a limit order. They put limits on the bids, and that's where the market makers take their opportunity. They take their opportunity and sell to them. Sell to willing demand, which is limit orders. And we saw what can happen here at top levels, at high levels. It's not a very good thing, right? Because it's a huge wick. But if you can understand that right here, just like Bitcoin, bottomed basically right at the low range, came back up on low volume, and then continued downwards. So it takes time to distribute. So knowing that the market maker is selling off they end up closing the candle bullish, and likely order book manipulation or volume, like we just saw in Bitcoin, again, only have more trapped buyers at the highs. So yeah, and they shake out weak short positions. This candle here would shake out basically weak short position, this wick, because they would be scared. But it would also trap more longs if anyone's buying the top here. So that's all we have for the candlestick patterns. Again, a quick little recap. We have a lower wick example. This one here is basically the same thing as a hammer, right here, the hammer. But it's the psychology of it that you really want to understand, is that, boom, they're closing their positions on market. This one here, same thing. Upper wick example, closing their positions on market. It's actually called the shooting star candle, and this is what the girl talks about. She talks about the hammer candle, the most important ones: hammer, the shooting stars, and the long leg doji, and of course the widespread candle, narrow spread candle, and the hanging man at the top of the market right here. Okay, so yeah, that's all for this video. Again, read and watch the description of this video. Compare it with your notes. Hopefully you are taking notes, or at least watching these videos multiple times in order to let it sink. I'll probably plan to make some more specific videos later, but this is going to be the start of it. I hope you guys like and enjoy and are learning a lot. Peace.